Okay, so now this is part 2 of the comprehensive example, so we'll be dealing with 2021. So we take all the information from the problem that relates to 2021, our pre-tax financial income, the depreciation for under each system. Of course, the difference here in 2021 compared to 2020 is that they've held the asset for a full year. And of course, we have the receivable from 2021 and also the municipal bond interest from 2021. All right, so we start with our pre-tax financial income of $315,000. Much as we had done before, we need to make an adjustment for the difference in depreciation. So we add back the GAAP depreciation a full year of $45,000, and we subtract off the Internal Revenue Code depreciation of $20,000. Now with the receivables, there's sort of two things going on. First of all, we had the collection of the 2020 accounts receivable, so that would be revenue under the Internal Revenue Code in 2021. And then of course we do have the outstanding receivable at the end of 2021, which would have been recorded as revenue under US GAAP, but would not be recorded under the Internal Revenue Code until 2022. Again, we need to subtract the municipal bond interest of $1,600. So together that gives us our Internal Revenue Code taxable income of $337,700. We apply the tax rate, and now we have our income taxes payable of $118,195. So our next step then is to calculate the DTL or DTA related to different items, and of course we're going to focus on the equipment first. And so the book value of the GAAP equipment at this point in time, it was $70,000. Now we have another $45,000 of depreciation, and so the book value of the equipment under US GAAP is $25,000. The same piece of equipment under the Internal Revenue Code has a book value of $30,000. Again, the previous year was $50,000. Now there's another $20,000 of depreciation, which means the new book value is $30,000. So there is still a difference in the book value. In this case, though, the book value of the equipment under the Internal Revenue Code is more than under US GAAP. And so that $5,000 difference is a future deductible amount of income. And so since it's a deductible amount of income, we know that there is a deferred tax asset related to this item now. So we apply the tax rate, and from there we get our deferred tax asset balance of $1,750. There was no prior DTA balance. So from the prior year it was a DTL, but there was no DTA in the prior year, and so the previous balance for the deferred tax asset is 0. And so the entry amount for the deferred tax asset is an increase of $1,750. But of course we also have to get rid of the previous year's deferred tax liability because its current balance is 0. And so to get rid of the prior $7,000 balance, we need to reduce the account balance by $7,000. So you can see that there's a DTA increase and a DTL decrease in 2021 related to the piece of equipment. So now turning our attention to the accounts receivable, the end of year balance is $3,100. There is no balance under the Internal Revenue Code, which means there's a difference in book value of $3,100 where GAAP is more than the Internal Revenue Code. That difference is a future taxable amount of income. We apply the tax rate, which gives us our new deferred tax liability balance of $1,085. We compare that to the previous balance of $840, which means we need to increase the DTL $245. So we take all this information and we do our December 31st, 2021 journal entry. We start with our income taxes payable, $118,195. We have the increase in the deferred tax liability related to the accounts receivable of $245, so that's a credit. We have the decrease of the DTL related to the equipment of $7,000, so to decrease the DTL, that's a debit. We have the increase to the DTA related to the equipment, that's a debit of $1,750, and from all this information, we can derive our income tax expense of $109,690.